Good evening. This is Jeff Scott, and welcome to this week's webinar. It is 7/17 on August 3rd, 2014. Take a quick gander at the futures, and let me just fix this. I did some changes to this. Okay, and you could see that right now the futures are soft. 56 down on the Dow, fair value. Whoops, let's see if they changed. Probably not. $4 on the S&Ps, nearly 8 on the NASDAQ, and minus 557 on the Russell. And it's early. Oil's down another 15 cents. Gold is up a dime. Pull up my PowerPoint and let's let her rip. So I entitled today, Bounce or Further Breakdown on the Horizon. So we'll take a look at some of the things I looked at this weekend and try and come up with an answer. Or maybe the answer is both, as we'll talk about. As always, this is for educational purposes only. Anything I recommend is in the spirit of education, not investment advice. I am a doctor, not a broker, and I am totally independent. What I do to support HGSI and other programs, I do because I have bought their programs, I like their programs, and I like to help other people use their programs and to use them with value. I'm not going to spend much time on this tonight, except just to point out some of my heroes and influences, whether it's Woodward and Brown, John Person, Elder, George Lee, some of the books that I've read, among others. And I have to be my own guru. I can't rely upon anybody else, and I suggest you do the same. And I became my own, quote, guru, which is probably an overstatement, through reading, live meetings, educational programs, and creating tools that help me trade. What I need on my desert isle, besides high-speed internet, I need a trading platform, TradeStation or Thinkorswim. The more I play with and use Genesis, I'm convinced that although I don't use it to trade from, it's now the platform of choice during the day to monitor the market, stocks, and look for buying opportunities. Post-market and during market for analysis, I still use HGSI, EdgeRater. I can do seasonality within Genesis. But I still have Magenta, Best Choice, and TradeMiner, and I like MarketSmith for additional fundamental updates. Usual picture, I ask you, where do you think we are? It sure feels like we're down, heading down into stage 4. That said, we are short-term oversold, and it would not surprise me whatsoever to see a bounce early in the week. That said, it feels different this time. No, I'm not saying that it's like, I say it's never different this time, meaning when the market gets to an extreme and you think it's different this time, it's not going to drop. I think this is kind of expected. I think this is summertime volatility in a market that hasn't had a major correction. And although we might get a bounce, I still think the bigger picture, intermediate, is probably down. Now, to get that opinion, I'm going to look at charts today, various screens, and try and build more than just what I think. Canaries index, you could see it's flat. So despite the market having a tough Thursday and Friday, Canaries actually traded up Friday almost 2%, over 1%, 1.36%, with a pocket pivot after a mobile breakdown from a squeeze. So Canaries are going sideways. If you think about the Canaries, I would say Tesla is my favorite stock in the universe right now to look at buying long. Amazon is just pooped. Facebook has pulled back but might move. LinkedIn's on a nice run. Netflix looks a little bit tired. Priceline's waiting on earnings, and Google also looks tired. Only one that's really problematic probably is Amazon. Current LLUR list, they broke hard, and I talked about it last week. Even sent something out to the Florida attendees where I thought I was giving the Florida list, but I was looking at this list early in the week and said it's selling off, time to get protective. And it sold off pretty hard. And then it bounced a little bit on Friday. Closed, I'm not sure it closed up for the day, maybe higher than it opened with a big long-legged doji, suggesting to me that decision time, and if it opens up, then perhaps we move back up. If it opens down, we don't. And to me, this is pretty important because first we're going to have to do is we got that 8-day, but really we're going to have to get above that 50-day, because sometimes where the 50-day acts as support the entire way up, it acts resistance the entire way down. So until I break above the 50, I'm going to be concerned. If we open down, I'm expecting to go down at least to the 200, and hopefully we'll bounce there. The Florida LLURs, more recent, done in June. You can see what the stocks are, and several of these, like Salix, VIPS, Southwest, GPRE, Therm, are holding up quite well. Not the energy stocks, and this had a lot of energy stocks in it. But interestingly, despite the tail here, kind of a hammer put in at a little bit above the 50 on the Florida LLURs. That could be symptoms or evidence that it's going to bounce this week. Finished up, or rather down, a little bit less than 1%, but did trade down much lower during the day. Market themes, EPS season's winding down, but there are plenty on the docket this week. Make sure you know when your releases are. Market sell-off Thursday, will it be more of the same or the beginning of another leg down by more of the same? Every time we've seen that 3, 4, 5% correction, the market has bounced. Will we see that again this time? Clearly, bearish sentiment is growing. Part of that is seasonality. Short-term oversold might lead to a bounce, but will the market be able to get above resistance? And as we talked about the last couple of weeks, most of these things haven't gone away, and we continue to climb a wall of worry. Just to update you on meetings, October, I believe it's 11th and 12th, emailed me for more info. John's great. He's got a 2-day meeting. He's going to let me speak a little bit at the meeting. George Lee's got an advanced user meeting in October that I will not be attending. I also will not be attending the PV meeting. I've got a red line through my dates in Vegas, mostly because Magenta Trader has already booked the weekend prior to the Vegas Summit, and I'm a little nervous about the weekend after because of it runs right into Thanksgiving. So I'm going to not sponsor a meeting. On the other hand, John Person talked to me this week, or at least his wife did, about potentially doing a joint meeting in Vegas. And then I am planning, I'm looking at various properties, another meeting in South Florida, most likely early February. Week ahead, still a lot of important things here. Factory orders, crude, claims, natural gas, productivity may all be moving. As you could see, we may be winding down on earnings, but there's still a lot of them left. Before opening, Cardinal Health, someone I used to work for in the past, I sold business to. Michael Kors, Trex, ANI Pharmaceuticals, a bunch of things that you might be interested in. You need to know when your stocks are going to report, because you get surprises when you don't know they're coming. My thoughts about the market. Last week, sentiment, etc., to the bear side. Good news finally became bad news. Growth versus rising rates equals volatility. I think we're going to get to the point soon where the better the news is, the more likely people are going to think Janet's going to tighten. Seasonality is against us. Last week was a great week for me. I raised cash. I protected my longs. I do a lot of married puts. And then, as I talked about when I did my worksheet of where I thought the market was going, I increased my short side. I did naked puts and shorts. I did OEX puts, made a lot of money on those. Contra ETFs such as VXX, TZA, SOX, SPXS, and ERY. I hope to lighten those Monday morning, but although I took some profits, especially in half my OEX puts, I left a lot of these positions intact because I'm still worried about the market. I also sold half of my TZA. This week, don't forget cash is a position. I'm expecting a bounce from short-term oversold. I will let the market dictate what I do. Do I lighten my shorts? Do I roll out of the puts? Do I increase protection in short positions if the sell-off continues? Or do we get a big move up and I go long, increase my net longs? I like to see the market get above short-term resistance before I jump back in. And it's time to start preparing for when we bottom and to make new HGS boxes. On that note, let's see what we can find out. I'm going to try and do less teaching and more my review this weekend. There's a lot to go through. I go to elder charts to see about the markets and whether or not they're giving me any sign that maybe I can jump back in. NASDAQ futures down a little bit so far today. Actually, I can't say that. Let me see if that's even today or if that was last week. I think that's probably today. Yeah, so NASDAQ futures look like they're right about where, actually, you know what? This is elder, so red could still be a positive day. So NASDAQ futures are up a couple of points, but still down, I believe, towards fair market value. Red, blue, blue. The red is concerning. I don't want to be jumping long NASDAQ futures or NASDAQ stocks without a signal, and right now I don't have a permission to go long. That is the NASDAQ. You could see what we had was weekly bearish, or daily bearish divergence is now gone. We still have some weekly bearish divergence, and the bearish divergences, as we made higher highs, we did not make higher highs on the MACD, and you could see here higher high on the MACDs, lower high despite higher high in price. So the NASDAQ should look just like this, and it does. The Dow got crushed way below the lower volatility indicator. High jump bar down to the 20s. Clearly, this is a position that you might be looking for a bounce, although it's still red. We've worked off the bearish divergence. Don't forget, from a monthly perspective, these markets are still net very, very positive. And although it looks a lot on the daily and the week, we're still in an uptrend on the monthly. If I look at the Russell 2000, also red, red, and blue, like the Dow, below the envelope, a position that the market likes to reverse from. It'll have to move up a little bit, and let's see if we can tell you when we're going to change color. Crossover occurs at 1115.38. So that tells me I only have the Russell needs to get up about 2 points for it to turn into blue. So we're not that far away from triggering sort of a easing of the rules and potentially an allowance to go into the market. But as it sits right now, it's red, red, and blue, and that's worrisome. The S&P 500 also below the lower envelope, also red. Let's get an idea of how high it has to go for its color to change and be a more compelling story about potential buy. 1922.21, no, that's the fifth. The fourth, it's going to require, my bad, I'm sorry. 1932.54. So I need about 7 S&P points, or 12 on the ESs to get to a crossover point there. And just curiosity, looking at the SOX. SOX came back a little bit on Friday. You see it did turn blue, red. So lots of reds, certainly no greens or anything that says it's all clear in time to jump back in. So I can look at the market and you know, it's pretty beat up. No matter where I look at, worse on the Dow and on the NASDAQ. One thing I want to point out on the S&P 500 is let's take a look at what happened on the hourly chart on, or let's make it to a 15, let's go to a 5-minute chart. And what you could see is the market sold off from almost the get-go. And you could see on the 5-minute chart we had a lot of bearish divergence as the market opened up. And look at this. You can see higher high, and on the MACD, a lower high. So showing decreasing pressure from the bulls, or bullish pressure. And then the market sold off between 10 and 12, 9:45 and 12 o'clock. And then it looked like sometime around 1 o'clock it was going to do a run back, and it stalled around 2:30 and then drifted. But I guess the important thing here is if we were looking at this as a stock and this was a daily chart, I wouldn't be as bearish because it looks like the damage was done early and the rest of the day was spent healing. So although the numbers did not get back to midline, we closed midway in the range between the initial pullback and the ultimate, in the beginning of the day. So nothing too exciting from a positive perspective on these charts. And let's continue on with my evaluation. I mentioned the level of oversold. So before I forget, because I forgot this before, I look at a number of tools to help me understand what the likelihood of this being a good spot for a pullback. So this is the McClellan oscillator, and that's in green. The spiders are in yellow, and you could see each time we, let me see if I can change that. Each time we get a pullback on the oscillator, we typically get a pullback in the S&P. And that when the oscillator bounces, the S&P or the spiders turn up. So we are at minus 740.56 on the oscillator. Most of our pullbacks this year have come with the oscillator not getting nearly to this length, plus 300, plus 200. And you could see we've had sort of a rising trend line of where these pullbacks occurred. We broke right through that trend line, but we are getting to a point where 1, 2, 3 previous and bounces occurred. So looking at the McClellan oscillator, very oversold. Will we get to minus 2,000? We might. Wouldn't surprise me. As I said, I'm still net short, but I'm ready to hit my change signal very quickly. But here is a McClellan oscillator falling pretty darn low. If I look at stocks above their 40-day price moving average, similar pattern here where we were not pulling back nearly as far, and this is going back through September of 13, that each pullback was less and less intense. Well, this is the pullback here, and again, the depths of these pullbacks are usually associated with the depth in the spiders. So one might expect that we bounce from here as we're clearly getting about as low as we've gotten in a long time on this. So perhaps more reason to be expecting a bounce. How about stocks above the 200-day price moving average? We're not quite there yet, which says it's more of a quick pullback than a gradual one over time. But you could see in February we got to only 41% above stocks above the 200-day price moving average. A couple of other things we could look at here. Go to T's. Let's see if I can find it here. Look at Treasury yields. Treasury yields ended up the week at 25.05, and that's again a place where they seem to bounce off of. And for now, the market seems to respond as the rates go up. Now that's kind of counterintuitive And what we've seen here is the markets have sort of, well, they've sold off as the rates have gotten lower. That's all I can really say here. I would think over a long period of time, these might be inverse related, but you could see with the recovery, the market traded up as interest rates traded up. And I think the reason for that's pretty simple. Every time the interest rates fell, there were questions about the validity of the recovery. And so the market has liked rising rates. Well, the rates are down here, have come down, and thus they're pulling the market down. So there's a number of things I look at. All of them tell me the same thing, and that's that this market is oversold. Other things that I like to do, let's open up my end of week spreadsheet. So we'll start with the Hindenburg. The problem with the Hindenburg is you need new highs, new lows, both greater than 2%. And we've got 3 trues. We need 4 trues to fire, but the new highs have just taken a dive, and they're less than 1%. So unless we get a bounce that's enough to take the new highs above 2% without clobbering the new lows, we're not going to fire a Hindi. Hindis would be a sign of a potential correction. No big correction has occurred without one in 50 years, yet only 1 in 4 Hindis are meaningful, and a series of Hindis, which we clearly don't have yet, is more meaningful. Bucketology, signaling a bounce. Many weeks ago, I did an analysis that demonstrated that when the buckets get to this point, more than 80% of the stocks in the S&P 1500 trading below the midline and over 30% trading below the lower band, it is normal to expect a bounce within a couple of days. Now, I'm a little bit bothered because we didn't bounce off of this that was done on Thursday. So Thursday actually lightened up some. We have less oversold than we are on Friday, or more oversold Thursday than Friday if you look at the stocks below the lower band. So that has me perplexed, but I did a nice chart of the S&P 1500 and showed every time we get here, usually within 2 or 3 days, we get a significant bounce in the market. Now, I've also been quick to point out that that analysis has been in a bull market, and in a bear market, this might not trigger a recovery, and I think this market might be changing its spots. This was as high, this was the 30th, which shows you that we had a pretty big move to the downside on the 31st, as we know, but we already were trending down with 2/3 of the stock below the midline. The last time I saw this was April 11th, and this is when I said to go into the market, and I said that within 2 days I thought we'd see a bounce. And it correlated pretty much with after tax day. Now, I don't feel the same here. It's not April. We're in a different seasonality. I am more concerned, but based upon the data, another sign signaling that we should bounce here. Here's a negative. This is the Woody indicator where green is good and red is bad. And we're in a pretty red area. These are all major indexes of percent B times bandwidth. We can see that on Thursday we had multiple shots across the bow with a lot of big kahunas to the downside, big kahunas defined as greater than 40% movement within the Bollinger Bands down on a single day. Most of the time when we've seen this, it's precipitated some tough times in the market, and it looks to me like this is precipitating another down leg. Now, if we bounce, then we're going to have to see some healing here very quickly, and a big move and a follow-through day or follow-through type day will give us a row of blues and maybe change our mind, kind of like we saw here on July 18th. I'm not going to spend a whole lot of time, but in EdgeRater, we can build out signals using some of George Lee's favorites, stocks in a squeeze with PSAR reversals, MOBOs, pocket pivots, and Keltner channel breakouts or breakdowns. And I just wanted to highlight today and I actually rank these from worst to best, and multiple potential shorting candidates, whether daily or weekly. If you look at Morales and Catcher code blue, you can see we get down to 32. We start at number 6, so 26 stocks meeting those criteria. If we look at them, several gold stocks are in here. Here's Tesla, which I think is actually looks quite good despite everything. Here's the code reds, and you can see they get down to 97. So a lot more of the code red, meaning stocks that are likely to go down based upon various signals that we've learned from Gil and Chris. I have built a spreadsheet for Person Pivots based upon his book, Candlestick Pivot Point Trading Triggers. In addition to that book, I highly recommend his green book, which they both go into stocks, futures, etc. He's not a big Forex guy. He'll trade currencies, but in the futures. But these are great books. So let me take a picture of this one too and put that on my worksheet. And I'm a big fan of his work and very consistent with the things that I've learned over the years from Ian and Ron when I look about things such as sector analysis, seasonality, average crossovers. Point on this slide is that there weren't a whole lot of high closed dojis, which are buy signals, but I did find a number of stocks lining up with low closed dojis, some of them off of support. And what I use this sheet for, which is custom and not available yet and may not become available, is to find stocks with lower high closed dojis sitting off of major pivot support. And I'll find a lot of the stocks that I look at through that. From a seasonality perspective, you can run any list in EdgeRater and get an idea of which stocks are likely to go up over the next 2 weeks or 1 month. FSYS, 9 out of 12 years, 13% return over the next month. I think it's a natural gas play on car engines or conversions. Might be something to look at. 10 out of 12 years, we have Valiant. Valiant's in a takeover battle with Allergan, with lawsuits and slamming on the TV. I doubt it's going to have a big move, but 10 out of 12 years up an average of 7%. It's a quick way to do seasonality. One thing you might want to do is look at market ETFs with seasonality. And here's a number of major market ETFs, and looking at 1 month, 2 month, and so on and so forth performance. So what's strong over the next 2 months? Gold, retail. XPH, I'm betting it's pharma. Let's see what XPH is. Problem with some of these spiders is I don't use all of them. I use several of them, so I don't always know what they are. Let's see. XPH is pharmaceuticals. Might be it. Look at that. Pull back to the 200-day moving average. Long tail, maybe getting ready to give us some opportunity. So I want to get an idea. Here's biotech up 1%. Here's a number. I look for up to 20 years. There's not 20 years on all of these. But one thing I saw was that these were the ones with the biggest return over the next 2 months. I made the list bigger and ran it against John's Person Pivots to see if anything is working right now. Low closed dojis are potential sell signals, and we've got low closed dojis on the financials. And although gold showed up on the last one, gold showed up here as a negative. Last week, I gave you some targets and some ideas of what I was going to do in the market. We dropped from the high close to 3%, only about 2% from where it was last Friday. Now, that's a pretty big drop in 1 week, but my gut feels like it's a lot worse. My target was about a 6% sell-off, and that's what I wanted to protect. So that would be 42.30. So we are below target 1 for me, which was a 23.6 retracement off the April low. I'm shooting for 42.30, which is a 50% retracement off that low. It's right about at the 100-day SMA, and it's 6% off the high. So we had a big move down early in the week. This is on the NASDAQ rather. On the S&P 500, my target is also 6%, which is about 1860. And we went right through my first target, which was the 50-day SMA, at a 38% off of the most recent up move. So far we're down, say, about 3% on both. What I said I would do last week was to buy OEX puts, which I got into at $8.30. I think I bought them on Tuesday. I don't think they were Monday that I bought them. I'd have to go back and look. And I decided to buy the near month because I think this is going to be a quick dump. And then I can either roll them or reevaluate. No reason for me to pay extra premium at this point. I decided to not do a spread. It would have saved me a couple of bucks. But here's what happened is net change, they went up to $28.90 on Friday. And I sold half at a $20.60 return, or 245% return. And special thanks to Dave McMullen from Houston, who taught us this years ago at one of the Anaheim events. I also went long, and I actually should put ERI in here too, a number of Contras, and I sold off some of them on Friday as well. Just to get you an idea of why I do Contras. Here's the VIX, which is not an ETF, which was up 34% for the week. That's why it was painful. The VXX, which is a short-term VIX ETF, was up 14.5. The energy-related direction to the bear side was up 13%. 8% on the S&P 3X bear, 7.5% on the small cap 3X bear, and the SOX has already come off a lot. It was up 2.73%. Now let's compare that with the market. Amex was down 4, transports were down 3.6, S&P 100 was down 2.78, S&P 500 down 2.69, Russell was down 2.61, NASDAQ was down 2.18. I could have shorted the NASDAQ 100 and I would have been up 2.78%. No premium risk, and it doesn't expire. But by buying the puts, I was up 245% on that position. So I will talk more about what I think, but I lightened up my shorts, but I still have a lot of shorts on as we go into the weekend. I do this type of analysis for myself. I just invite you for my oral discussion of what I'm doing. So let's take a look at the market. I noticed I screwed something up on a filter, so let me very quickly see if I have to fix it. You go into, I will come back to this piece. I just think I need to fix something. At least I did on my other computer. That's right. And that is wrong. So I'm going to go into my filter. Okay, and I want that to be, so the way the filter's set at equals 0, it's just going to find the groups that move to negative force today. That's not what I want. There's actually one that does that. So I want everything that's perfect, perfect. All right, got that fixed. So let's take a look, top-down view at the major indices and see if we can't make heads or tails of this market and give you more evidence of why I think we might see a bounce, and then also talk about how I'm going to play that bounce. So if you rank by short-term more than long-term, although there's some 2 to 3 week data in this, you see that VIX was up 34% over the last 5 days, closed in the upper 3 quarters. Treasury bonds went up in value, no surprise that the yield dropped, although for 5 days they were down 1%. In fact, if you look over the 5 days, the only 2 things that were up were volatility and the dollar. And I mentioned the dollar last week. That rising dollar not necessarily great for the stock market. Everything else was down. On Friday, you had gold, bonds, volatility were semis, and the utilities were to the upside. The rest were down. So if you look at what we live in small caps, down 2.5 on the week. The Russell 2000 down 2.6 for the week. So it was a tough week for growth stock investors. If we look over here, I get some other information. I see that the Woody indicator is red everywhere, which means they're on a sell sign by Woody's indicators. The only thing that's not on a sell sign are bonds, the dollar, and then volatility. I see everybody except for bonds and gold, and there's no force on things that don't have volume. So that ignores the VIX in the semis, the NASDAQ. But we see mostly red under force as well. If we look at accumulation and distribution, the dollar is the only thing that's at a B, and the small stocks are at a E. So really tough week in the market. Most of the things are red on the Bongo Daily and green, mostly red on the weeklies. More to come back on the Bongos. Let's take a look at some of our favorites. So I'll start with the S&P with my traditional messy chart, which I think most people that came to my meeting switched to my messy chart. No volume here, so I don't expect to see anything here. And I'm just looking at this to point out a couple of things. We saw kahunas down on the S&P 500. We saw them on Thursday. We saw them on Tuesday. We saw them on the prior Thursday. 3 kahunas in a row to the downside on any index or any stock should tell you that there's a lot of problems going on. We saw Phoenix, which is calculated on either the NASDAQ or NYSE, depending upon my settings. This is calculated on the NYSE, and it shows you how much damage was going on in the market. The Phoenix in red is our equivalent of a follow-through day to the downside, more evidence that this market has dumped. We had a MOBO breakdown from a squeeze on Thursday. We had a PSER reversal on Wednesday, and our bongos turn red. So any way you look at it, this is a market under pressure. Now let's go into the simple moving average charts. So the question I have, I can't answer this, unfortunately, or else you'd have to really pay me the big bucks, is this just another one of these? And are we going to bounce? Or are we getting to the point where we're about to come back as we did in November of 12, in June of 12, and visit the 200-day moving average? If that's the case, then we have a little bit more damage to come. And in fact, just among friends, I'll estimate the high from being up here. 200 is going to be going up all along, but that's where I got my 6% risk in, was pulling back to a rising 200-day moving average. When did this one start? It started in September, actually. Yeah, ran up into September and sold off until the middle of November. So it remains to be seen as to whether or not we are going to look at another one of these repeated 5.6. That was the deep one. Here's one that was probably about 4%. 7% from top to bottom last year. Then we had about 5%, about 5%, and they're getting smaller and smaller, about 4.2%. And from top to bottom here, forget the close, we're a little bit less than 4%. So I can't tell you. I can just tell you how I'm playing it. And here's what I'm thinking. I'm thinking I have no idea what this market is doing. I'm thinking it's going to do whatever it wants, no matter what I think. If I run from the April lows to the high, we closed on the 38.2%, or right above a 38.2% pullback. That might be it. That would be a natural position for us to move off of. If I ran one from back here and ran it up to the top, we are at the 50% retracement of the last move up after this pullback. So you expect sometimes to see, whoops, I don't want to do that, hold on, my bad. You expect sometimes to see a confluence around multiple technical events to be potentially a bottom. So the question becomes, will this be support and does the market go up? Now, and again, it's a natural place to bounce. Now, if the market goes up, now I got a couple of other concerns. So let me do a couple of I've got 50-day to get through. I got the 200-day here. Now, mind you, both of them are rising, so these numbers are going to change over time. What I've got to see is if this market is making an up move, I've got to see it not only get to the 50, and what I'd expect it to do is this, till it breaks through. That would be a great sign. And that would be the bullish move. Now, I don't expect it to go right through the 50 on the first attempt. I pointed out here how many times it got stopped. So I could stay out of the market and wait for a break above the 50. Or I could say, that's the good news. The bad news is this. I could run up to that 50 and fail and head right back down to the 200. Or I can just trade down tomorrow right down to that 200. And then once I get there, hope I bounce. So I've painted where I'm sitting. I think that this is a natural place to bounce. And I think it is based upon, as I showed you, the confluence of Fibonacci retracements. This looks like a spinning top, which I guess at the bottom, if I flipped it over, it would look like a reversal candle. If the market opens down tomorrow, that's not a good sign. So that's how I'm going to play it. If we open up, I'm going to lighten up my shorts because I'm going to expect a test of the 50-day to see if it's resistance. I expect a bounce. And based upon the bounce, I will make a decision about whether I increase my shorts. If we open up down tomorrow, then I'm not going to lessen up my shorts. I'm going to lessen up my longs and make the market prove to me that it's not going to do this instead. Because I don't want to go long on this. I want to be shorting these retracements. So that's how I'm going to play this tomorrow. I do think that there's many reasons why I could say I expect the market to bounce. Let's take a look at the VIX. So VIX rises, market falls. Now, if we go back to 2013, we saw the VIX getting to 2150. If I go to 5 years of a chart, on monthlies, we used to see VIXs getting up to the 40s. We are clearly seeing that VIX has changed. It may still be just as valid and important, but the bottom line is we've moved up a lot from around 10 to 16, 17. We moved up quickly to get here, and we had a big sell-off in the market with that. So the issue will be whether or not we bounce because of the VIX. So I know that when the VIX is rising, I short, and when the VIX is falling, I like to be long. So a lot depends on whether the VIX is up or the VIX is down tomorrow or over the next few weeks. So I'm going to be closely watching the VIX because to me, that's going to be an important clue as well. We are, as I said, at a natural buy point, but no one cares what I think. We don't have to bounce just because I think we're at a place that we're likely to bounce. If I look at the Dow, not as pretty. And in fact, if I go and I put the fibs on that one, I haven't, so I'm curious what I'm going to find out. We pulled all the way back to the 61.8%. So might also be a normal place to expect a reversal. Dow's got a much longer way to go to get back to the 50. So to me, is it going here? Or is it going here? And I'm going to wait and see what it does on the open and how it trades over the next few days. What about the NASDAQ? The NASDAQ shows you something that's a lot better. Okay, let's do the same thing on the fibs. I don't normally do this many fibs, but I think it's a worthwhile exercise. So NASDAQ closed at the 23.6% retracement. NASDAQ closed at what would be a natural Fibonacci place for the stock to close, or to stop falling rather, to find support, I guess is the word I'm looking for. It also closed 200-day moving averages at 40.59, 50 days at 41.55, and it closed at 43.10, which is, no, that's not this day, my bad, hold on. So, fix this. All right, so it closed at 43.52, which is just 11 points below the 50-day moving average. There's not a lot of work it's going to take for the NASDAQ to get above that 50-day moving average. And if it can get above that point, then again, good news for the bulls. The bad news is for the NASDAQ, if it doesn't, and it pulls down to that, we'll just turn off that, hold on. And if it pulls back to that 200, there you have your, something tells me that didn't come out right. Let me try this one more time. 4% more on top of the 3 you have. There's your 6 or 7% correction. So NASDAQ will be interesting to see. Russell 2000, destroyed. Now I got bigger problems. I better give me some more information. Here's my line in the sand on the Russell. I guess it would help if I open this up. I hold my shift key and I go to the right, I get a straight line. So let me just, actually what I'm going to do is kill that. I'm going to go back to this one in February, hold my shift key, bounced off of this once back here in November. It was resistance, turned into support twice, 3 times, Potential target on the Russell would be to pull down to this level of support, which would be another 3%. Not a big drop from here, frankly. So the Russell, I would put my short-term boundaries are, can it get above the 50? And if not, is it going to go down to support? So that's what I'm going to be looking at as potential here. So a lot's going to depend on how this market moves. Other things, the VIX we looked at, but just to show you, had a wild day on Friday with some long tails. Perhaps sign of topping, but let's wait and see. It can go higher. And frankly, when I look at 17 and I put it on a monthly and within HGSI and get a lot more data, a couple things come out to me. This is nothing compared to 11 and 10. The other thing is this is where it bounces off of, and it's right below that 200 monthly moving or 200 weekly moving average. So VIX reverses, market goes up. Market goes up, VIX reverses. Dollar. Dollar had a little bit of a pullback on Friday to the 8-day and bounced. Higher dollar, bad for the market. Dollar's in a nice bullish move. Gold. Gold crossed below the 200 on Thursday, got back above it Friday, kind of sitting in a squeeze here. If I bring down my squeeze stuff, although I don't see a squeeze, it feels like a squeeze with the 200, the 50, the 17 are all coming together. But a squeeze is defined as the Bollinger Bands contracting within the Keltners. Looks like it's squeezing, so maybe one is coming. But gold at a place where it'll be interesting to see how it declares itself. Silver probably looks a lot like gold, sitting right on the 200. A natural place to bounce. A drop below the 200, this is what happened when it dropped below back in March, led to a pretty profound further sell-off. So those who believe that gold and silver cannot fall further, I'm not sure I necessarily agree with that. I hope they don't. Free fall on oil last week. Let's look at a weekly. As low as we've been since the second or third week of January. And if you're long oil exploration stocks, this is commodities, my bad. I thought I was hitting oil. Here's oil pulling back. Again, since the middle of January, as low as it's been. Natural support. And if I say the same as I said about everything else, perfect place for it to bounce. It'll be very interesting to see if we get a bounce here. Actually closed higher on Friday than it opened, but still a down day. So Dan Fitzpatrick, who's one of the guys with a video blog that I like, says 3-day rule: pros, semi-pros, us. And that he might say that sitting on the 200, the selling is over and that it's going to bounce. Will be interesting to see. PSER is in a sell signal. Regardless, oil's had a big sell-off, and so have your oil exploration stocks. So, give you a sense of where I think the market is, and I really think we're at a fork. What do I think is going to happen? Could be a question, and I know people get mad when I give you choices and I don't tell you exactly what I think. Well, what do I know? I'm just like you. I can just guess. What do I guess will happen is this. My guess, G-U-E-S-S. In science, I would call it a hypothesis. I can lose my money on my guess. You shouldn't let me lose your money on a guess. My guess is that the market is going to trade up this week and get up to that 50-day moving average. That is my guess. My guess is that then it will bounce around and that will act as support, and eventually the market's going to sell off. That is my guess. I recognize that based upon the market we've been in, it might just go straight up to new highs. And I have to be prepared for that. So my guess is the futures will turn around, the market will trade up to that 50, and it will bounce off resistance. My guess is that it will retest and fail, but I'm prepared for it to retest and ultimately break through and potentially go to new highs. I am prepared, although I'm not expecting it just to sell off down to the 200 straight, but I am certainly prepared, okay? I am certainly prepared to see the market do one of these and work its way down. So, hypothesis is it trades up the next couple of days. My guess is the 50 will hold as resistance, and then we'll either bounce around underneath it or potentially have an ice-hole failure, take out at minimum this low, and potentially go down to the 200, getting us to that 6% pullback. But I'm watching to see where I'm wrong and recognizing that there's a very good chance I'm wrong. Either it breaks up or it starts off the week down. I have no idea. I'm just like you. If I knew, I wouldn't be teaching you. I'd just be living in the Tahiti on my millions of dollars, which I would have to, but I wouldn't give it away from how I did it. It would be a secret. I don't know if anybody has that secret. All right, what else can we do? We can look at the internals like you won't expect them to be. Put the S&P 1500. Let's go down to the user views that I have, iCharts. Went bongos on the SP 15 on the weekly. Weekly bongos don't happen all often, and usually they signify some chop or further pullback in the market. Daily bongos, this is a directional movement, getting to the point we expect it to bounce a little bit. Accumulation, oh, wrong one. Hold on. I had to go back to when it's got created from the stocks that has volume. E's up, A's down. Reds are bad, greens are good. Greens trending down, reds trending up. And as we talked about before, we had a phoenix on the market on Thursday, which is a follow through to the downside, and we are distributing. If I look at A's plus B's versus D's plus E's, we see D's and E's are up, and not only are the A's and B's down, the C's are down. If I look at the percentage of stocks, we look at 5-to-1 days, not only did we have a 5-to-1 downside day looking at advanced decliner issues and advanced decliner volume. We don't get these all the time. We had 5-to-1 down. We had worse. We had a 10-to-1 extreme down day on Thursday. See that doji on Friday right above the 200. Normal place to look for a bounce. And then here's looking at percentage of stocks above their 20, 30, 50, and 200-day moving average. And then they put a moving average on them. And we're getting to the point where we're pretty well sold off. So this could be more evidence that we're stretching to the downside and getting ready for a bounce. All right, so hopefully I haven't depressed you too much. Next thing I usually do is get an idea if anything is working. It's going to industry groups, and let's look at the T group. See, we have 196 groups. Now the T, unfortunately, does not just look at one day. It looks at 1 day, 5 day, and 13-day force, which is about 3 weeks. And so this is over the last 3 weeks. These are the things that have come up to the top. Couple of things that I notice. There's a little bit of green on the top, but it's mostly red on the forces and the bongos. That's not good. I notice that we have very few stocks with an A, or groups with an A. We got one group with an A for accumulation, and it's coal. We know what we think of coal. Tells me the weakness in the market. So I want to know what's working right now, so I use the 2-day force up and down to give me a look over the last couple of days. This is it. Usually we see 40, 50, 60 groups that are 2 days up on the force index. We have 6 groups here. Very quickly, household products. If the best stocks I can find are Procter & Gamble and Clorox, what does that tell you about the stock market? It tells you it's defensive. Right? Defensive. So we look at, and this here, we never talk about this. This is a bingo. This is the babies out with the bathwaters on a stock or an index. This is the Phoenix, which is the stock, the index rather, the NASDAQ for the market. The bingo is on the stock itself. When I see a kahuna and a pocket pivot and a PSAR reversal and flip my forces in my daily bongos, I find this very interesting. This was a huge move on Friday. It was up 3% on a very down market. Now, the other thing about this group is they pay dividends. Procter & Gamble pays a 3.2% dividend. The problem with this chart is it's below the 50 and the 200. It's been in a downtrend. This is the leader. This tells you the deep caca that we're in this market. So nice move up, might be interesting, not my kind of stock. I like to see it get above the 200, break above the 200, then that might become support. Doesn't have great earnings per share growth. It does have a dividend. They had good earnings and they're dropping 100 brands. The market liked it. Same pattern, bingo, Kahuna's, pocket pivots, Clorox, another big high growth stock. And you notice the group has been horrible up until the last 2 days when it turned around. We're not talking leaders. Church & Dwight also make house products, bullish engulfing candle, pocket pivot, Kahuna, multiple bingos. You know, 2% dividend, downtrend. I can't buy this stuff. Energizer Holdings, a little bit better. At least it's above the 200. Pocket pivot and a Kahuna, DI crossover, mobile breakout, makes money, growing earnings per share. Multiple 1.7. They must be the battery guys. Portable power. I wonder if they're going to do anything with Tesla or any of the car manufacturers. So that is Energizer Holdings. So from a top-down perspective, you can see how few groups are working, and these are not growth stocks. Pharmacies and drugstores have been strong. I've called them a winner in Obamacare. And they're a winner because anything that you use more of, if you have insurance, will benefit in going to the drugstore. Walgreens is an interesting story. It's not a pure play drugstore anymore, as they have a call to buy AmerisourceBergen as they're trying to connect the entire integration of the drug from the manufacturer to the patient, integrate that in one company. Remains to be seen. They've been in a light sell-off, and they had a bullish engulfing pattern on Friday. And a Kahuna, not that exciting. Rite Aid was a leader until it too sold off. Now this is what, bouncing off the 200 is what I expect some of the indexes to end up doing. Not that exciting. Second leading group. What does this tell you about the strength of the market? Property and casualty insurers, Allstate comes up to the top. And Allstate trying to get above the 50. I don't know about you guys, but I'm not getting all my excitement on these stocks. Bingo broke above the 200, not leaders. And that's because the leaders have been clobbered, story after story. All right, what else do we have to the upside? You get force by looking at price change times volume, and these are the only ones that were up. Home improvement, kind of interesting. The housing's giving some different opinions, yet all of them in this group have positive force. Here's Armstrong Worldwide for flooring. Lots of bingos, Kahuna, but the stock's been in a downtrend. Mohawk, the carpet makers, not that exciting. Masco, I think these were electrical components. Nope. Millwork, plywood, wrong company. That must be the Maztec. I can't get excited. I get it. They're positive force for the group. Fortune Brand Security, a bunch of pocket pivots and a stock below the 200. No interest for me. Maybe you like those things. Department stores. Oh, here it is, J.C. Penney's. Don't you want to just go out there and go shopping there, let alone buy the company? They lose money. But best looking chart of the night so far. I joke, but I'm not kidding. On balance volume is rising. Broke above the prior high of the last couple of weeks. Yeah, it's not really much of a high. Everything's green from above. The group rank is going up. Just hard for me to get excited on J.C. Penney. What about Kohl's? I like Kohl's. So here's how I look at Kohl's. If I was thinking about stocks to be interested in, I like Kohl's. I like the on-balance volume. It's got resistance here. So I might put a buy stop a little bit above the 200-day moving average. Everything is green. Group is going up. And it had a mobile breakout from a squeeze on Wednesday and held up the rest of the week despite the market sell-off. I like Kohl's. And we also said earlier on, seasonality says retail might lead over the next month or two. Bonton, too destroyed for my taste. Dillard's, at least almost in an uptrend, coming out of a squeeze, a little bit of a pullback there. I have a pocket pivot, on balance volume is positive. So I might put Dillard's and Kohl's on my watch list. Not so much so far. And then lastly, healthcare supply chain. Now this is happy days for me because much of my net wealth is tied up still in Cardinal Health stock. I was such a believer in their story that even after I left the company, I kept a lot of my stock. They have earnings before the market on Monday. I do have some puts in. I'm not that, it's too much of my net worth for me to not protect myself. But I'm excited because both McKesson and AmerisourceBergen have big moves up on earnings this week. Here's McKesson. I love this chart. Mobile breakout from a squeeze. Pocket pivots, Kahuna, on balance volume to new highs. I think this one goes higher. And you notice they're starting to have some acceleration in earnings per share growth and trading now at about what their multiple is. McKesson is a distributor with a big IT franchise. Been a big fan of them for a long time. AmerisourceBergen is the other big one, and it had a pop-up about a week ago, which made me feel positive about Cardinal's likely earnings. We'll see what they are tomorrow morning. I have no insight into them. I haven't worked there for over a year, just my gut. Express Scripts had a move up this week. Their pharmacy benefit management. They've been living under the 200. I don't necessarily love the pattern there. Looks like they're getting some resistance at the 200. What I like about Express Scripts is they have some overlap with the distributors in the chain, supply channel. They're also in the business of taking cost out of healthcare. And as I said multiple times, one of the problems with ACA is there's not enough cost coming out. So I think Express Scripts and the other one that's in the same family, which pulled up to 200 and installed Catamaran, you can see it failed at the 200. So I leave it alone for another. This is another healthcare stock in the cost containment world. You notice that that's it on the winning groups. We're missing a lot of our favorite groups. So if we look at to the downside, whoops. Exploration and production. This is why I have ERY, because I still own some of these and I wanted to hedge my bet. I should have been smart and had my own conviction and dumped all these suckers. Because let's take a look. Looks like the price of oil, Athlon, dead. ConocoPhillips. Hopefully it's smart guys, semi-smarts, and the last ones to sell are us. Hopefully the market moves up on day 4. Pioneer Natural Resources, Bill Barrett clobbered. One of our favorites, Fang. So in the midst of a big 3-day sell-off. So these guys got clobbered. Show you why I like ERY. It was a cheap stock that had, while those guys are selling off, my ERY, let's just take a look at ERY. Over the 3-day sell-off on those guys, to the peak, it was up 16%. But on a stock that's only $14, you got to buy a lot of it to get that. And you don't want to make these investments, they're trades, and the reason why you don't want to make them an investment is, see this 200-day moving average? When it's that much higher than price, you could see going back to, well, this is daily, that's going back to February, it's been in a downtrend. But this stuff has been in a downtrend ever first it came up. It never was $2,000 a share for ERY, but it keeps doing reverse splits. So it's moving now. It's a short-term play on the drop in the price of oil. What else is weak? Internet media. I know Gil was talking about shorting Yelp on Thursday. It was a good short. Looks like it's failed at the 200-day moving average. Does it take out the low, which it already did, and bounce? Or does it go down to visit the 50? Not like it makes a lot of earnings. Facebook, I've got a big position in. Facebook looks like it's threatening to close its gap here. If the market goes up, I expect Facebook to go up. A doji, after, it's sort of a flag, be a natural place for the stock to move up tomorrow. We'll see. Google, selling off below the 50. Not my cup of tea. Quihu, listened on the board. I got out of it here and been kicking myself for selling it when it ran up here, but I fortunately didn't jump back in because it ran right back down. I mean, these stocks are tough right now. And in the market we're having, I think some of these high beta stocks are not the place to be. Cena going nowhere. So failures in this group, although I still think Facebook has opportunity. Communication equipment. Eris, this has been a leader. People didn't like some of the earnings story. Gap down. This is why you got to know your earnings. You went from 34, if you sold it the day before, with a high of 35.83, and then it closed at 29.30 with a low of 28.70. So you have to be very careful. This is depressing. I was depressed before because I already did this once, but and you could see banks, semiconductors, biotech. This has been a big leader. These guys really kind of look a lot like Quihu. They ran up, they pulled back. Here's Biogen, had great earnings. Looks like it wants to come back. Gilead, still one of my large holdings, but pulled back some. This guy is a freaking financial machine. What's holding it back is that everybody's afraid that somebody's going to come after them with their $80,000 pill drug that cures Hep C. Alexion, I can give you a Biogen, great companies, great products that are expensive because they're worth it. And nobody's saying no to them. They make you treat as to the label, but that's how we're supposed to treat anyways. Pharmacyclics, whoops, had a nice little run early in the week, and then it came back. Here's one that I like. It's a great company. They're having expansion of their critical drug. They have a market cap of $8.7 billion on a new drug launch. Notice that they came back and tested the 200. My guess is that that holds and it goes higher unless this market just dumps in the toilet. This is a stock, so you got a big run up and a flag. So I'd be looking at this one closely. And I know the company extremely well, but without any current or ever inside information. So if I can break above my flag here, I might want to be in this guy. Now, break down below 200. take my comments off. I would expect the 200 to be support. I'd put my stop not far below that 200-day moving average. So this was really depressing. I apologize. One thing we might want to do, though, is say there's a chance that we're at a bottom. So if we're at a bottom, I need to prepare my shopping list. And if you've watched me over the years, or you've been to Ian's meeting, you know how much we like the HGS boxes, or Ian's boxes. And these are high octane stocks based upon 5 years earnings per share growth and annual year-over-year growth that we like to put together as a shopping list to buy off a bottom. Well, I showed you my buckets, so one could argue that we're getting close to a bottom. I'm not sure I believe it, and I told you what I think might happen, so I'm not jumping all in. But if we take out some of those averages I showed you and hold, then we might need to look. So let's start with all securities, and I want to go up to mine. That is mine, and scorecard combo filter, no filter, all stocks. Let's start with 8,999 stocks. And let's put a filter in. And I've done this before, but I don't know if I've done it on this computer. So let's see if I have what I'm looking for here. I'm looking for a filter. Well, we're going to create our own filter. Here it is. No. All right. So I put together a filter earlier, which took that list of 8,000 down to 180. So what we have in this filter, let me make sure, is last close above 2, 50-day moving average volume greater than 250,000, and ERG greater than 240, which means EPS rank, relative strength rank, and group rank. So that gives me 180 stocks. So let's make a group from list. And the last time I did this, I called it Bounce Off Bottom April 13. So I'm going to call this Potential Bottom Bounce. And let me tell you, I'm not expecting this to happen, but just in case. So I created a list of stocks with ERG over 240. And just, I want to go into my designer real quickly, and I want to add, so I don't want to forget that I did that. So these are potential bounce candidates, ERG greater than 240. Okay. So now I'm going to open up the Spectrum Analyzer. And I'm going to find under HGS Fundamentals and Earnings, HGS Earnings, HGS boxes. And what it found for me is that there's 112 of these stocks are found in the HGS boxes. So box 1, greater than 50% the last 2 quarters, greater than 100% on an annual. And you can go through each of these on earnings per share. So all we're doing here is creating a vehicle. Let me do it better for you. I don't like to sound confused or to confuse you. So let me see if I can find something that can make this easier. Percent annual earnings last 5 years, last 2 quarters, current earnings compared to quarters four quarters ago, the prior year's earnings. And you built, sorry about that, you build a matrix based upon stocks that meet these criteria. Box 1 through 9. Box 10 are mattress stuffers, and box 11 is cash. This dates back to 92. And the reason you do this is time and time again, you will be able to pick stocks off a bottom that are leaders. And I'll show you some results very quickly. Pause for a second so you can come back to this, stop it, and take notes. 1992-93, this is the performance of all the stocks in the various boxes between September 11th and February 12th. 5 months, you can see the returns based upon the box. Here's 98-99, 190 stocks in the boxes. They average 67% return. You can see how box 1, box 2, box 7 are the big returners. In this case, here's box 7 down here, I'm sorry. Here is 9/1/2010 to April 29th. Here's the boxes. Here's the return. Box 1 was up 125, box 9 was up 50, box 7 was up 106%, while the S&P was up a whopping great return, 24%. So the boxes outperformed. Here is June 23rd, stocks based upon the boxes, and here's the return. S&P was up 6.8%, box 1 was up 31, box 2 was up 25, box 7 was up only 12. All stocks in the boxes were up 16 versus 6.8. The last time I came out and talked about the boxes was in April, and we had a nice return. All but one box group beat the S&P between April and July, and the leading boxes, as usual, are 1, 2, and 7. So now that I've created these, you can go down and see some of these oil stocks are still in here. Coming off a bottom, they might explode. And to me, the reason why these work is off a bottom, I think earnings are what drives. And now if I go see the plus, where it says make groups from slice, parent user group is going to be what we just did, which is potential bounce off the bottom. And these will be ERG 240, box stocks 8.3. This is one of my favorite things in the program. I hit OK. And it'll come up in a second and tell me when it's done. I usually we're done. So now, I've now created for you, following what I did, box 1, box 2, box 3, box 4, box 5, and so on and so forth. I am a big believer that earnings matter. This has not been that kind of a year, unfortunately. In fact, don't need to see this right now. Let's see if I can find what I want to do here. So I'm going to show you one of my favorite things to do in EdgeRater, which is my second favorite program after HGSI. And I'm going to do the warehouse view. And I'm going to go in here, and I'm going to try and find here it is, year-end 113. So these are all the fundamental values of the stock market on year-end this past year. And I want to see what's worked for 2014. So we're going to look at from January 2nd or whenever the year started to now. So we're in August 3rd. And I am going to make sure, I'm going to hit OK there. I need all securities there. And let's go ahead and hit run and talk among yourselves, because this will take a few seconds. And what it's going to show me is that couple of different things. First thing is it shows me is that, well, first thing is this is the number of stocks in a various group. So I usually cut out the last between 280 and 300 and 0 and 20 because there's not enough stocks, and one stock will make all the difference. And what it shows me is that the market hasn't had a big move this year between plus 10 and minus 10, but there's actually a trend that as your ERG gets better, your return has been worse. That is totally unusual, and I've not seen that before. I see there's no relationship this year between earnings per share rank and return, because typically the more you are in the higher ranking, the higher earnings. There's been no relationship between relative strength and return, nor group rank. In fact, stocks that were distributing, and these are all the numbers based upon December, stocks that were distributing in December have outperformed stocks that were accumulating. And box 7 is always my favorite box and has outperformed the other boxes. So this is very weird. And the only thing I can say is that everybody's been so convinced that this market is going to turn around and do bad things that perhaps the market is skewed because things that did not work in 2013, like REITs and utilities and MLPs and other things that were not great performers have led, and so that's just evidence of market rotation. This is what I'm used to seeing. Now I've repeated this, and as you'll see here, I'm using data that I got 12/29/2012, so this will be data for end of 2012. So I want to know what happened in 2013. What worked in 2013? Hit run. Sometimes that can't be it. Nope. Try that again. Here we go. So this is what you're supposed to see. So again, take away less than 20 and above 80. What you see is a trend here from a little bit over 20 to 50% return. So higher ERG stocks won. EPS rank did matter, although not greatly. The market as a whole was up, but the higher EPS rank, the higher return. Relative strength mattered, although some low relative strengths and low earning stocks did well. Group rank didn't seem to matter. Box 1, Box 2, Box 6, and Box 7. Box 7 had a 40% return, and stocks that started the year accumulating A and B outperformed. So this is a crazy, crazy year. So if you're kind of scratching your head, I don't blame you. It's very confusing. Lastly, let's just take a look at a couple of my favorite screens and see if there's any stocks to look at. I think this is really going to be a game of looking at a shopping basket like the boxes and waiting to see what the market does. So we start with 8,099. One of the things I look at is sprinters. And typically you'll see 50, 60, 70 sprinters in the market. You saw 48. Now the nice thing about sprinters is that these are technically very solid stock with good fundamentals. And there's some good stocks here, so let's look at a couple of them. This is a long one, I apologize, but I think it's an important weekend. Pacific Ethanol, certainly a leader, pullback to support, looks like it wants to go again. Kahuna, on balance value is positive. I like this one a lot. GPRE looks a lot like Pacific Ethanol. Rex Stores, pull back to the 17. They are in the business of biofuels as well. So biofuels are hot. VIPS, a retail Chinese play, flash mob sales, pull back to the 17. It's been a good place to buy. OmniVision Technology, pull back to the 50 and breaking out like this pattern a lot. eHouse China, don't like this as much, although I've always called this stock, I think I've called it before, like a cheap, I guess it's more, I used to think it was a cheap VIPS, but I think it's more of a real estate play. So I might go through this list and see if there's anything here that looks interesting. I might look at volume plays. 5X type filter, Bally's. Don't know why, but I want to figure out why Bally's had a Bible gap up or a big gap up on Friday. Don't like the close. In fact, I skipped it when I saw this, but Bible gap up, mobile breakout, got above the 200. Don't like the fact it closed at the low of the day. But big kahuna, interesting day nonetheless. The other one with 5X volume, Hutchinson Technology, they're in the disk drive assembly business and stopped at the 200. If it breaks above the 200, I might be interested. I would know where my stop would be. It's a cheap stock, probably won't get that interesting. All right, 3X type filter. A couple others that looked interesting here. Spirit Aero Systems, Bible gap up out of a mobile breakout from a squeeze. Anna Kahuna had earnings come out, broke up on earnings. That might be an interesting thing to take a look at. Let's take a look at a weekly chart. You see why I like it. It broke out above its weekly high. That looks interesting. So there are some stocks in here somewhere. LinkedIn, I unfortunately got shelled out here because I missed the big part of the move. I'd like to see it hold above 200. Look for a retest early in the week if the market sells off. This was a great stock to short. And this whole way, the 50 moving average was resistance and a great place to short. Then it became support. Let's see what happens at that 200. The other one I want to show you here was Techmira. Big news down here about the doctor coming back to Emory University for treatment of Ebola. The last time Techmira ran, besides it being biotech frenzy, it ran because of an Ebola scare. Techmira is the leader in developing treatments for diseases such as Ebola, as well as for hypercholesterol and other things. So that might be one to take a look at as well. Other things I look at my reversal close at a squeeze. These are stocks that are in a squeeze that have a right underneath a PSR reversal dot. I like to see them above the 50. CBOE, Gentex, these are all below the 200. I just have a hard time getting excited. I like things in uptrends. At the 200, ADR to gappy. The SA bothers me because I know it means it's Argentinian or something. Agricultural company, farming company, based in Luxembourg. All right. Everything's green, mobile breakout from a squeeze with a kahuna. If this breaks above the PSAR dot, I might be intrigued. And this is why I do this scan, is looking for stocks that look like that uptrend in a squeeze right underneath the red dot. Other one I look at here are those stocks that are within 1% of free parking. Don't like it when treasury bonds are up there. We looked. One that I thought was interesting, or continue to think is interesting, is Activist. I've liked this stock for a long time. Let's put it on a weekly. You can see kind of what I like about it. Had a huge run up. It's been going sideways, digesting a recent acquisition. I wouldn't buy this stock until it got above its PSAR dot, but it had a pocket pivot, a kahuna, rising on balance volume, had it up over 1% on Friday, kind of a reversal candle on Thursday. Get above this PSAR dot, I'm going back long on Activist. Now, here's a depressing thing that I found this weekend. These are the number of stocks in my database, or this database, which are having, let me go in to start with, no filter, all stocks, 8,099. Typically, somewhere between 1,000 and 2,000 of them will have daily and weekly bongos that are green. So now I just got to figure out where I put them. There's only 302 stocks in the entire database that are bongo daily and weekly green. Many of them are stocks that we've already looked at. Lastly, I'm going to show you the ones that came up in my buy list as being interesting stocks. There are not a lot of them. And let's show you all stocks. They're all going to be above 2. These were some of the stocks that I found to be interesting on my review. Many of them we've looked at this evening. Few other comments before I go. There were some semiconductors they've sold off, but TriQuint and RFMD have been leaders. They're the same because RFMD is acquiring TriQuint. I showed you OVTI. Trinity, Greenbrier, Railcar sold off some. I still have a lot of hope and belief in Trinity. Pacira Pharmaceuticals, PCRX. I commented on the board about this. They've got a product that's got probably $1 billion of sales opportunity. They have a $3.5 billion capital. Problem is their product is 100 times more than the generic, but they have an injectable local. If you had surgery, they could give you a local injection. You don't have to take any orals, so there's no abuse potential. It's long acting, so you come back every day to get it. That's what the excitement is. I just think it's way overpriced. Yes, they run the risk of somebody bigger coming in. Maybe somebody buys them out, might be a good thing. I just don't think that a long-acting version of a generic pain med is that exciting personally, but obviously I know nothing because this stock has gone crazy this year. I think considering how the feds have come down and been concerned about abuse of narcotics, that's driving it. Internet-based services, LinkedIn, Facebook, YY, I'm looking for a bounce. United Rentals is probably hope more than reality. It's a stock that's been in a major uptrend that I have interest in. Pull back to the 50, which might be a great buy point as it's been. Oh, by the way, if you don't know this puppy, what a beautiful stock. So on that note, this has gone on long enough. You all have a safe week. I'm not sure that the market isn't going to change directions more than once this week. So don't get trapped to the bull side or the bear side. Be open-minded, expect the unexpected, and decide what you're going to do before the market opens, and then be prepared for what you get. Again, this is for educational purposes only, and have a great week.